Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Hey everybody, welcome to Wealth Unfiltered. I'm Samantha Parinello and I am your host. This week's episode is Real Estate in 2025 Market Insights with Spencer Levy. Spencer is a global strategist and he is an economic advisor for CBRE. He was kind enough to sit down with Chris and I this week, and we were able to dig in on market insights, megatrends, inflation. We even talked about current events and their impact on multifamily, as well as all other asset classes and where he sees this year's investments going. So we're so excited and we're so grateful for you to be here, and I want you to go ahead and take a look at the clip. Today, I have my resident guest expert, Chris Parinello, and we are very excited as we have a special interview for you all. We have the one and only Spencer Levy. He is the global client strategist and senior economic advisor for CBRE. Welcome.
Thank you for having me, Samantha and Christopher.
Thank you for joining us. We appreciate you taking your time today.
Delighted to be here.
Awesome. Well, for those of our listeners who don't know who you are, could you just give us a little bit of your background?
Sure. Well, you've given my title, but I've been in the real estate business for 30 years as a lawyer, a banker, almost 18 years at CBRE in a variety of roles, but all comes down to one thing: giving the best advice I can to my clients, and hopefully we can give some today.
Awesome. Well, I'm so excited. As a company that, we do this for a living, and we really, really need people like you to help us advise, the investors, as well as make sure that as a marketing team, we're putting out the right information. We really appreciate you coming on here. So we're going to get started with a couple of, normal, easy questions, and then I'm sure Chris is going to dive in with a little bit more. But my first question for you, we have a lot of uncertainty going into 2025. I feel like there's a lot of people who don't really know what to expect. And a lot of the time from our investors, they're looking for indicators, macro, micro, that they can look at that will help them make investment decisions. So if you have some that you would suggest, these are what I would look at for real estate. Could you give us some of those now?
Well, I'll start with a piece of advice I actually give to rising professionals, but I think it's the same advice I give to investors, that the most important picture on your wall is your mirror. And the reason why it's your mirror is because you look in that mirror and say, well, what kind of risk and reward can I handle? Because they say, oh, I want the highest returns. I'm like, well, you sure about that? Because if you want the highest returns, you're also going to have the greatest risk associated with them and the greatest risk of loss. And so most people, I would say, is, look, the best advice I would give is this: what is the time horizon of your capital? And what is the cost of your capital? People say, well, do you like New York City office? Do you like San Francisco multifamily? It's like, well, I like them all if I have the right capital and time horizon to go after them. So, which brings me to your question. It's like, well, what are you looking at? So I look at things from both a macro and a micro perspective, but always through that prism of two people can look at the same information and come to different conclusions if they have a different source of capital, different time horizon. And so the macro things I look at are the same things that a lot of economists will look at in terms of inflation. And in real estate, it's really, the whole industry comes down to that one word, because it's implications for interest rates, it's implications for the cost of construction, it's implications for, is it good enough to buy a piece of real estate when I can get a AAA bond at 7%? I mean, these are the things you have to ask yourselves. Like, well, should I go this way for something that's riskier, less liquid, or should I go for something that's less risky, more liquid at this return? And so my point of view in real estate is, if you look at it versus a bond today, I don't think you're looking at it entirely correctly, because real estate, the types of real estate that we think are going to give you the best returns over time, give you the combination of both yield, which is what the bond gives you, and and then it gives you capital appreciation. Now, I think it's fair to say that capital appreciation over the next several years ain't going to be what it was like over the last 10 years when cap rates were going down. But nevertheless, you still can get a great yield and some capital appreciation over time. And your yield can increase over time if you're in the right asset class, right operator, right market. Just some headlines there of the things that we like right now. We like those markets that have great live, work, play neighborhoods. So, do I like New York, San Francisco, Chicago, Miami? The answer is yes. I like them all, but I like submarkets within them that have the live, work, play, great infrastructure, great capital, and particularly in markets like a New York or a Chicago or a San Francisco that candidly people are down on. People are certainly down on San Francisco and Chicago, but I think the opportunities for upside is tremendous. San Francisco gets 72 cents of every AI dollar. And so because of that, they're going to be moving up soon. And since they're at bottom or probably past bottom at this point, great opportunities there. So it goes back to an expression, hit them where they ain't, be greedy when people are fearful. But those are the places you should be looking in those types of submarkets. And then the types of asset classes I think are actually secondary because I have some great clients who just buy the submarket, but some of them will specialize in things like data centers, multifamily, and industrial. And that's okay too if you go with the right operator.
So you mentioned some of the markets that you're high on. Are there any where you would say, just don't touch them this year? Like they're a no-go.
Well, I wouldn't say that about any market because I think when you're in hot submarkets, they are hot for the long term. Now, there are markets that change, right? So you would say that CBD markets in many cities are down, and they may have been a hot CBD market in downtown areas in San Francisco, in LA, in Boston. Great cities, but their financial districts in each of these markets is not doing as well as some of these what you might consider to be tertiary locations. And the tertiary locations, like you see Fulton Market in Chicago, hottest submarket in Chicago. Wynwood doing as well, if not better than Brickell, which is the hottest CBD market in Miami. So I wouldn't say steer away from any particular market, but you want to trade in those markets that have great growth potential, but have already started to grow. You don't want to be a complete pioneer and go all the way out and look for something. I would go to those markets that are already growing.
Yeah, absolutely. I totally understand that. Do you have any, what I would say, like economic risks that investors should stay away from right now? Like, are there things where you're like, I'm seeing this trend and I would stay away from this?
Well, it's easy for me to say that some asset types can be overbought at times, some can be oversold at times. And look, it's fair to say there's a lot of money going into data centers today, a lot of it. And there's a good reason for that because the demand for them is insatiable because of AI and crypto that need all this computing power. They also need a lot of energy. So I'm not going to say that you shouldn't go into data centers. I think it's a great place to go, notwithstanding the fact that there's a lot of money chasing it. But there are some other places right now where there isn't money chasing it. So like take the other end of the spectrum, traditional office. It's almost like, I'm surprised my colleague who's on the phone here didn't put the buzzer under me when I said traditional office because so many people are down on it. Not me. And the reason why not me is for exactly the opposite reason of data centers. There isn't a lot of money going into it. People are down on it, but you can get the best office building in the best submarkets in some great places at intergenerationally great pricing that will make you money over the long term. I know of deals that have been bought north of a 10 cap that you can't argue to me that those won't be 7, 8 cap deals 2, 3 years from now once people get past the point of saying, putting the baby with the bathwater, kind of like they did with retail 10 years ago. 10 years ago, people was like, oh, all retail is dead. But they were putting Class B dead malls in the same category as open air grocery anchored. And it was a mistake. And that's why people are flocking back into retail today. And that's why I think if you have the patient type of capital and you don't have to deal with investment committee that's going to shoot you down just because it says office, great time to buy office right now because it is oversold big time.
I am pretty sure that I read recently that CBRE purchased Industrious, which is the like co in like office space. Do you have any color you want to add to that, or maybe why that you like you were talking about offices, but is there anything that people should know? Because I mean, if they made that big purchase, I just want to know if you have any insider tips, information.
Well, I have no insider tips, but I will tell you I did interview for my podcast last week in New York City, Jamie Hidari, the CEO of Industrious, and we asked him that very question. And I think it's a great opportunity for the industry, for our firm. And I'll tell you why for the industry and for our firm. Because Jamie said something on that show I want to just mimic here. This is my new favorite phrase. So I was talking with Jamie about different forms of real estate because his form of operations doesn't just apply to office, it applies to industrial, data centers, retail. And I said, Jamie, when came up in this business, the big four asset classes, office, industrial, multifamily, and retail, we used to treat them as bond-like instruments. So if you want to use Ron Popeil, the TV advertising guy, you set it and forget it, right? He's like, well, that was a long, long time ago in a land far, far away, Spence, because now all real estate is, quote, operational real estate, operationally intensive. You don't just create a bond, create a lease, and say, I'll see you in 10 years when you're renewing. No, you have to be operationally intensive, which is exactly what Industrious is. It's an operationally intensive form of real estate ownership, management, occupancy that is now going to be moved, not moved, but the teachings of it are going to be expanded into all real estate, not just office, data centers, industrial, otherwise. So I think the beauty of it isn't just that business per se, it is the teachings of that business that will be applied elsewhere, which will make everybody better off.
Yeah, no, absolutely. You were mentioning office, you're mentioning retail, and then we were just discussing that. But when you talk about timeline, so multifamily, typically when you have an investment for multifamily, you're looking at 3, 5, 7 years, sometimes up to 10. What is the traditional timeline that you would expect for somebody? Because you were talking about time horizon for capital. So what if they were going to invest in, whether it was retail or office space, what would be the right now and today, what would be the normal timeline for that?
Different forms of multifamily, different forms of retail have different time horizons. So if you buy what we would classify as, quote, value add or opportunistic retail or value add or opportunistic multifamily, which means it needs capital improvements, it needs lease up, that type of stuff, you're going to have actually a shorter time horizon for that than you are for what we would call core, or which is stabilized essentially, or core plus real estate, which is stabilized but maybe in a secondary market. And so when you look at these different categories, you say, well, that same retail asset 3 years from now, which is value add, they're going to try to build to core. They're going to try to redevelop it to core so that the next owner can own it for 10 to 20 years. And it goes right back to your risk reward profile. If you want to have a stable yield over the long term, but not get as high of a return, buy core. And there's plenty of places to buy core, publicly traded or otherwise. But if you want to have something that is going to get a higher return, but a shorter turn on it, it's value add or opportunistic. So there's no one right answer. It's 3, 5, 7, 10 years. But I will say this. There has been a fundamental shift in the business since I've been in it, and I've been in the business for 30 years, which is when I got into this business, it was a much more steady Eddie business than it is today, where people would typically hold longer. It didn't have as big of a institutional sponsorship as it does today. It used to be mostly families, high net worth individuals and the like that owned most commercial real estate. That's now turned on its head. It's now most of the Class A product is owned by institutions, which has actually shortened the time horizon by which you own real estate from something that would typically be 10 years plus to something that might go into this 3, 5, 7 year category, depending on the type of capital you have, depending upon where in its life cycle is a piece of real estate, whether it's core plus value add or opportunistic.
Awesome. Wonderful. Thank you for answering that question, because I know you have a couple questions. I know I've been taking all the questions. So do you want to step?
No, no, of course. Yeah, Spencer, first of all, I don't know if you were at NMHC, but thank you and CBRE for the most entertaining event that I think I've ever been to a real estate conference. The one you guys threw at the Raider Stadium was really, really fun. So diving into the questions, how do you think the recent policy changes are going to affect, real estate, specifically multifamily. And what would you tell investors, depending on, whether it's like an institutional family office, individual high net worth, as they're looking at what happened in 21 through the end of 22, and now they're looking at some of the opportunity and some of the reduced basis. Should they act? Should they wait? What are you telling folks?
There's a clear split right now in the words and actions of two basic categories of investors. On one hand, you would have the traditional institutional investors. On the other hand, you would have the high net worth capital. They're acting differently today. Why? Because the institutions very often are saddled with older deals, disproportionately office deals that they have to unload. They also, many of them have redemption queues where many investors are asking for their money back. The high net worth individuals, on the other hand, aren't looking at it through a short-term prism, looking through typically a longer-term prism. So interestingly, I see more of my high net worth investors buying and building today at the riskier end of the spectrum than I am seeing among those institutions, because it goes right back to what I said to Samantha at the beginning: lower cost of capital, longer time horizon. Now, to your question about policy changes, and I think that's fair to say, there's concerns about tariffs, taxation, immigration. All of these things can have implications for our business if the new administration goes to the extreme on any one of these things. Now, we don't think that's going to happen. We think it's going to be somewhere in the middle, and we think that the goal is to grow without inflation. We'll see if that happens, but nevertheless, I think the most extreme positions are unlikely. I do believe that you will see some changes in tariffs, which we already have. I do believe you're going to see some changes in taxations, which is going to be largely an extension of the 2017 Tax Act, and maybe some modifications for things like increasing the amount of SALT deductions you can have, state and local tax deductions. It's immigration, I think, is the wild card here, because immigration has implications for our business. First, in the construction area, where about 30% of all construction workers are immigrants. Then we have the certain types of real estate like hotels and certain forms of senior housing, particularly when you go up to higher forms of continuum of care, where they need a lot of labor. And so anything that puts a crimp in the amount of labor that's out there could negatively impact certain segments of our business, like construction, like senior housing, like hotels. But once again, you have to put everything in perspective. Are they likely to go to the most extreme ends of what they've been suggesting? We don't think so. And so because of that, I think the implications to our business are going to be less impacted by federal policy, more impacted by macroeconomic conditions, led, of course, by, are we going to get inflation under control? How much will interest rates come down? Which is something that, while tariffs, taxation, and immigration have implications for inflation, the reality is that they have less control over inflation than does our central bank.
Yeah, you mentioned interest rates, and what is CBRE's or your personal stance on, do you really think that interest rates will continue to fall after the meeting and they decided not to do a rate cut? Do you guys have any information on that?
Well, we have our house view, and then I have my view. So that's why my house loves me, because I say, this is your view, but this is mine. But at least I give some love to our house view, and our house view is generally quite good. So our house view is that we see the short end of the curve, two rate cuts in 2025, maybe another one next year, but it's going to terminate somewhere in the mid threes, the short end of the curve, which is right now is in the mid fours. So 100 basis points plus or minus in the next 2 years. The long end of the curve, which is now hovering around 4.5%, we see that hovering back closer to 4% over the next 2 years. So it's going to get lower, but it ain't going to get a lot lower, and it's going to take a while. And so because of that, our investors have to reset their expectations. And that's actually a good thing in a certain sense, because people aren't going to wait for a brighter tomorrow of much lower interest rates, which should spur more sales and investment activities this year.
Yeah,
That's great.
yeah, no, it's great for our investors. What I was going to say is that, we keep seeing the word like slow landing now instead of soft landing, and we keep watching things really slowly unfold in front of us. How do you have any investor insights on will there really truly be a recession? Should we be worried about that? Because, multifamily is considered recession proof. And so I want to understand like what they're really saying about, are we really going to see a recession, or do you feel like we've learned from our past history and they're really going to be able to navigate us out of that?
Well, first of all, I don't mean to knock multifamily because I'm a big multifamily advocate. I'm a big affordable housing advocate. But talk to somebody who bought assets at the peak of the market, whether multifamily is truly recession proof, because there are a lot of multifamily folks out there that unfortunately have broken capital structures. Because if you paid something with a three handle on it, and now the lowest cost of debt you can get has got a six handle on it, guess what? There's a problem. And so I would say that the overall demand side of multifamily is recession proof because people need it. Now, I will also put a shade of gray on that. As you go further up the quality spectrum to trophy class A, that stuff has softer demand during a recession than when you go down that quality spectrum to workforce or capital A affordable, because people are renters at the top end. They're renters by choice. Once you go further down, they're renters by need, and that leads to a stickier form of tenancy. So again, I don't want to go and say, oh, multifamily is recession proof. There's shades of gray there, right? But I think what you should look at today is what happened after the global financial crisis. Now, I'm not putting where we are today in the same zip code as that, but there's lessons to be learned. And the lesson to be learned is this. First of all, everybody was waiting for the sky to fall of all these bad debt deals to come to market, lots of loan sales, deals for pennies on the dollar. Now, while we are seeing deals for pennies on the dollar in the office sector today, we're not seeing a lot of them. And we are not seeing a flood of loans hitting the market, in part because the banks are writing them down and many of them are choosing to hold versus sell, though we are seeing an increasing number of banks take the assets back. So that's a micro comment of we're going to see more of it, but not a flood of it. From a macro perspective, I think the single biggest risk factor out there is that we missed on inflation. If we missed on inflation and we see a couple of months of spikes in the cost of CPI or in wages, that is the one risk factor that could drive us, I believe, into recession, which is the bad news. The good news is that if that leads us into recession, interest rates will come down. We hope, because if not, we have what's known as stagflation, which is low growth, high inflation.
Yeah, absolutely. Makes tons of sense. Thank you for that insight. Chris?
Yeah, global megatrends. Anything that you're following that affects the United States?
So the two biggest mega trends I follow, one of them I mentioned earlier in this program, which is the change in the nexus of economic activity in urban areas from what might be considered CBDs, central business districts, to these what might be considered secondary live, work, play neighborhoods. But the other megatrend that I think that has global implications is reshoring. And I've been talking reshoring well before the new administration because of many of the changes that occurred, frankly, going back a decade, but really accelerating during COVID when we had changes in law, including the CHIPS Act, which brought more semiconductor manufacturing back, the Inflation Reduction Act, which also brought incentives for more manufacturing coming back, and quite candidly, geopolitical tensions that's bringing more manufacturing back. And when I say back, I mean back to the Americas, not just the United States of America, because notwithstanding some of the current disputes with Canada and Mexico, Canada still has 5 times the amount of skilled labor immigration in the U.S. on a percentage basis. And the average laborer in Mexico makes 10% of what they make here. So there's a clear reason why we should be acting as a unit of sorts, a regional unit, which is not dissimilar to what they're trying to do elsewhere in the world. But I think that's a major trend that our real estate investors need to follow, because when you see where these new manufacturing sites are, they're going to need other real estate. They're going to need multifamily, retail, office, pertinent to or near these facilities to house workers and for other functions. You need a lot of industrial for suppliers. So I think that reshoring trend is not only something you should watch, but you should exploit it by going to those areas, many of which are even more tertiary than these live, work, play neighborhoods in dense urban environments. These could be in the upper Midwest. And what is driving a lot of this manufacturing to the upper Midwest? It isn't just economic incentives. It is cheap water and abundant power. So I think one of the great things that's going to happen because of this need for data centers and manufacturing is going to lead to an energy revolution where you're going to see those places that have cheap and abundant water and energy are going to be the long-term winners.
I really like that. So yeah, I think, one of the areas that we've focused, at Viking Capital is in those tertiary markets. think it's been tough to find deals where there was a ton of supply built to make the case for buying into those areas right now at the cap rates that they're trading at. But we've really found a way to kind of look at like South Bend, Indiana has been kind of like a really nice place. And then some of those areas like Atlanta, San Antonio, Austin, Dallas, just like 30, 40 minutes away. Any kind of thoughts on those types of submarkets, or are you focused more on live work places?
Well, your time has come because I speak to large institutional investors every day, and I get thrown out of their offices a lot too. I got to be thrown out of their office 5 years ago when I said you should buy retail. They say, "Oh, we can't do that. We got crushed." Yada yada. What are they all doing now? Buying retail. And these secondary or tertiary locations. What have I been saying about Indiana? By the way, I just talked not at Notre Dame, which is in South Bend. I just was in Bloomington last week speaking at University of Indiana. And where am I going tomorrow? I'm going to Cornell University in Western New York. What do they have in common? Lots of water and opportunities, and where you can build multifamily, where you can build other asset classes. But the beauty of them isn't just the moving nexus of economic activity. This is where you have to look at the broader macroeconomic conditions. Say, is now the time I should invest in secondary markets? The reason why people didn't invest in secondary markets historically, in part, was due to the real or perceived lack of liquidity on the exit. So if you were to buy in South Bend, Indiana, you know who's not showing up there when you sell your multifamily deal? Most of Wall Street. But will that change? Now, they will change in South Bend if it's student housing, because student housing is an exception to a lot of things where people, if you're big, near a major university like Notre Dame, people will back up the truck on that sort of thing. But if you're in a market, let's say outside of South Bend, would they go for traditional multifamily or office or retail? You're going to have a much thinner institutional pool. But what I've suggested to my institutions is this. Over the last 10 years, over 2/3 of the average institution's return was through capital appreciation, cap rate compression. Um, Over the next 5 to 10 years, most of it's going to be through operations, meaning NOI and then NOI improvements, net operating income improvements, which opens the door to these secondary markets. Why? Because you're not depending as much on exit cap rate compression in these markets, number one. And number two, why not take the higher yield you can get in a South Bend, Indiana, versus what you can get in a Chicago or San Francisco and New York? Because if most of your money is current cash flow anyways, take the money and run. Take the current cash flow and worry about the exit later. So I think it is the salad days for these secondary markets because of the change in the investment profile, because of the movement of manufacturing to these areas. And then when you have terrific secondary markets like a South Bend, like an Ann Arbor, like a Bloomington, I can go right down the list because I teach at all these places. Those are places that have not just the higher yields, but they have a tremendous growth driver in the universities. And these growth drivers, you got to look for them. They're universities, they're healthcare systems, and they can increasingly be entertainment venues. So I was just in Madrid, Spain, and I went and inspected the Real Madrid Stadium and the pertinent real estate. And they're seeing that's where a lot of the retail is happening there. But that's not unique. You go to Silicon Slope in Salt Lake City, that's where the new soccer stadium is. And I can go right down the list of showing these economic drivers. If you can find one in one of these secondary markets, you can get higher yield and a long-term durable demand driver.
That's like music to our ears.
I
I
know
love
my audience. No, but no, but look, I wouldn't have said it if I didn't believe it. But I'm also, I'm not going to like hide the ball here. You go to a secondary market that does not have a durable demand driver in it, you can't invest in it. Certainly, an institution can't invest in it because you're not going to get the cash flow. You're not going to get the exit either. And so this is not a every secondary market is created equal. They are not. You need to look for these 3Ds, durable demand drivers, which are typically universities, healthcare systems, or some type of entertainment function.
Absolutely. I have a question for you. So when we talk about kind of the shift and that we've been seeing in demographics from the Gen Z generation and the millennial generation, we also talk about the affordability gap for purchasing homes. How do you feel like these will shape the future, maybe 25, 26, 27, like the near future for multifamily investments?
Well, it's a great time to be a renter or to be a landlord in a multifamily project because there's the amount of new supply is falling off a cliff because you can't build multis because it's too expensive. Hard to build single family, it's too expensive. And so there's limited supply, people who want to rent. And if you can go to a high density place like Manhattan is one of the best markets in the country for multifamily right now, great time to be a landlord, great time to be an investor in those projects. And it's all because it's unfortunate that on the reason is that Gen Z can't buy a house. And because the interest rates are too high and the buy versus rent decision is out of whack and people aren't selling their single family homes. Why would you sell your single family home if you have a 3% mortgage? And that's the decision that a lot of people are making, which is leading to this terrible vicious cycle that the implication of high interest rates is profound, well beyond commercial real estate. It impacts small businesses that have lines of credit that have doubled in cost. It implicates the Gen Zers who can't buy a house. It implicates everybody who can't buy a car. It is profound, and that's why lower interest rates are necessary if we're going to jumpstart some of these things that need to be jumpstarted. Even though the GDP is growing at a good pace, the economy is growing at a good pace. Once you go one layer below that at the micro level for things that are interest rate sensitive, the average consumer is in a difficult place right now to do the things that a typical consumer would do, buying homes, buying cars, and the like.
How long do you foresee this being the trend, or do you have any insight to that?
Well, I think it's going to be the trend for a long time. I think we're in this terrible never land of high interest rates for a long time. Now, if we get this recession from something other than inflation staying sticky and interest rates drop, that will improve it. But nevertheless, because what happens is when there's a recession, the Fed will typically drop rates like a stone if you take a look at the last 40, 50 years of history. But nevertheless, unfortunately, our house view is that we're going to be in this soup for a while, which is bad. But the good news is that people are getting used to this high interest rate environment and are going to transact, because what matters in economics more than where we are businesses and consumers' expectations of where we are going. And because those expectations have now changed, people expect inflation to be stickier for longer. People will act today rather than waiting for a better, cheaper time tomorrow.
Yeah. What do you say to the developers out there that are brave enough to start projects right now, that basically figure out a way to make it work with the higher cost of capital, and they're really banking on being able to deliver into low supply?
Well, I don't call them brave. I call them courageous. There's a difference. Brave to me is, well, I guess they're similar, right? Brave, courage. A famous general once said that courage is fear holding out for a minute longer. So there's a lot of ways we can talk about this. But to me, my high net worth individuals are building as much as they can right now for precisely that reason. Lower cost of capital, and know that 3 years from now, when their job is complete, they're the only game in town. It is a great time to build. It's always an oxymoron that the best time to build is at the bottom of the market. Well, it still is true. And I think that what I say to them is more power to you. You're doing exactly the right thing if you can endure the higher cost of labor, higher cost of interest rates in the short term. I 100% agree with those developers doing that today. But it's easy for me to say when somebody's got to walk into an investment committee and they can't get a 6% yield to cost, which is sort of the magic number to break ground on any job.
Yeah, great. Speaking of new developments and, higher cost of building, one of the, current events, which is the devastation that happened in California, how do you see what's happened there and their need kind of impacting, all of new development across all sectors?
First, a very personal shout out to my own colleagues and to everybody who's been impacted by Southern California. But CBRE was headquartered in Southern California until a few years ago. And so we have dozens of our colleagues that have been impacted, many of which have lost their homes. So it's a very highly personal thing. And it's a terrible tragedy. At the same time, is it possible that there is a silver lining to the apocalypse, right? And, Rahm Emanuel, who was then President Obama's chief of staff, said a tragedy is a terrible thing to waste, or a crisis. He said a crisis is a terrible thing to waste. That was the actual quote. And look, I'm not looking to do anything negative here. I think there actually can be some positive things that can come out of this, horrific situation. The first one is permitting relief. So you've seen the governor of California suspend certain permitting rules for environmental regulations and other things to reduce the permitting time, which could take years, down to months. Well, that should have been happening a long time ago, particularly in the affordable housing realm, because people are considered to be quote unquote housing poor if they pay more than 30% of their take home pay in rent or housing costs. The average person in California pays more than 50%. It's inexcusable. And it's largely due to onerous permitting rules that have done it. So silver lining number one, I think that people are going to look at these permitting rules and be more open and allowing people to have looser permitting rules to do stuff. So other places have already been on that train. You take a look what Calgary, Canada did. They reduced their permitting rules so you can convert an old office building into multifamily, start it in months rather than in years. Florida has the Live Local Act, which tries to do something similar if you put in affordable housing. So silver lining number one potentially is people having a more honest conversation about permitting. But silver lining number two is this, and this was a pure coincidence, but it happened. So the morning that the fires really blew up in Los Angeles was January 7th. What did I tape on the morning of January 7th? My podcast on property and casualty insurance. And we had the global head of real estate insurance from Aon on the show. We had CBRE's own head of insurance on the show, and we had a senior executive from Walton Street, big private equity firm, talking about it. I think there's a silver lining there too, because one of the real challenging things about these increasing mass disaster events is property and casualty insurance costs have gotten extraordinarily expensive in places like Florida, Texas, California, and people are going to be priced out unless they look at insurance differently. And looking at insurance differently is this: insurance is a financial instrument that mitigates your loss. It is not your sole source of protection. I think it's going to increase resiliency. And right now, again, going back to the same split of how institutions think and how high net worth individuals think, high net worth individuals are investing much more in resilient assets than there are institutions. And you're like, well, that doesn't make any sense. Well, it does if you go right back to the question you asked, Samantha, about time horizon. High net worth individuals have a longer time horizon. And because of that, they're prepared to put the incremental dollars in upfront by using more resilient materials, concrete versus wood, or building your building 3 feet above the floodplain rather than right at the floodplain, things like that. There might be an institution who's going to get out in 3, 5, or 7 years, and you can't make the case that they're going to get a better return on the back end. So I think, again, if there's such a thing as a silver lining in a catastrophe, the silver linings are people are going to take a more rational approach to permitting, a more rational approach to property, casualty insurance, and resiliency. And while it's awful at present, things will get better over the long term.
Yeah, absolutely. I love that you touched on the silver lining because it is devastation. You know, Chris and I actually met in LA, and we also have a lot of friends, family connections, previous employers, and watching the havoc that happened, you know, it's kind of nice to hear somebody have a perspective where there could be some good that comes of the chaos and the sadness, because you don't really hear it in the media. Everything is so sad, and it is, and you see the devastation, but it's kind of nice to know that there could be some good that comes of it, and hopefully that helps the people who live there.
You would hope that people will take a big picture view towards this. Like, what is the end goal here? Right. I think it's, and again, I'm not here to talk politics, but I'm involved in politics to the extent that I'm on the real estate roundtables. I'm the chairman of the research committee, so I meet with politicians all the time. But I think there is bipartisan support for one concept. In order to solve the affordable housing crisis, we need more affordable housing, meaning we need more supply. And if that is in fact the end game, I think we're going to find a way to get there. And the ways to get there include permitting relief, rational approaches to resiliency and property and casualty insurance, and then you're going to need some government incentives for things like more LIHTC credits, low income housing tax credits.
Amazing. Absolutely. So we want to thank you for the time that you spent. And I just want to ask you one final question. As somebody who is deep into the knowledge and you talk to so many people and you do all the research, if you today were going to make one investment, you don't have to be specific, but maybe a class, an investment class, what would be your next one?
I would be, I get asked that question all the time. And I said, I go to the track and put it on the number 4 horse on the 4 race. No, that's not what I would do, though I might like to do that nevertheless. But nevertheless, I would say that in the near term, the data center revolution is only beginning, notwithstanding how hot it is, because of the need for power and water. So it's a good train to get on in the short term. And it may be longer term. But I think another great train is retail. Retail was disfavored, and cap rates are going to compress there. I think office has so oversold. It's a great time to get in there in the right building in the right submarket. But I think that the housing shortage is so dire in the United States that if you build the right job in the right submarket and hold it over the long term, that's a place where I would be doubling down my eggs right now, put my eggs in that basket, so to speak, because I think that you can't lose over the long term by building homes in a country that's probably, 7 million units short.
Yeah, absolutely. Wonderful. Do you have any
least.
last questions, Chris?
No. Thank you so much, Spencer.
We
Thank
really
you very much.
time. Thanks for joining us on Wealth Unfiltered.
Thank you.
What an impactful interview that was with Spencer, and we're so grateful for his time. I would say the biggest takeaways that we have from this episode, number one being the silver lining coming from the California wildfires. With the devastation there, it's very difficult to find any good that could come of this, and it was just very enlightening to have that positive shift from such a really devastating, impactful event that just has very recently happened. So I appreciate the candor he had, and it's something that really touched both Chris and my heart in a very personal way. So we're really grateful for that. Second is, doubling down on development right now was, I think, one of the best things that we could have heard. For people who know Chris's background and what he's currently doing with Viking Capital, they have a development deal that they're doing right now. And for us, like knowing that somebody like Spencer Levy says, this is the time, and if anyone can do it, then this would be a wonderful investment, just really holds true to what, Viking is expecting, what they're doing. And it really helps strengthen, I think, even the way that Chris felt about it, when we discussed it later on. And I would say the last thing that I was really, what I took from it that I really enjoyed is when I asked him about, markets. And he was talking specifically about secondary markets. And Chris said, what about, Dallas? What about Austin? What about Indiana? And there were certain places where he said, if you would have asked him this, just a few years ago, he would have thought, absolutely not. But because of the growth and everything he's seeing, secondary markets are not only now they don't only have, small investors, LPs looking at it, but institutions are going to be looking at these areas, and really that strengthens so many more markets that people maybe hadn't really thought of previously. So I really enjoyed the podcast. I really hope that you enjoyed the interview as well. And we really appreciate all of you taking the time to listen in. And if you have any questions that you'd like us to ask, we always ask you all to hop online, send us your questions in, and we'll be happy to answer them as well. All of our guests that we have, we try to sprinkle in your questions. So please absolutely ask us. We love to hear them. And thank you so much. And we look forward to seeing you next time. Thanks so much. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.